5 tax-saving tips for real estate investors. Hi, I'm Phil Pustiowski with FreedomMentor.com. I'm a full-time real estate investor, real estate mentor to thousands at this point across the United States and Canada. I've also been a part of several thousand transactions over the past decade. And in this video, I want to break down some simple but powerful techniques on what you can apply if you're real estate investing to save money on taxes. That's always a good thing, right? To save money. Now, quick disclaimer. I am not an accountant. I'm not a CPA. So I'm not giving you tax advice here. I'm simply giving you some ideas, some tips that you can share with your tax professional. Does that make sense? Okay, great. All right, so the first big tip is not very complicated. Get a qualified tax professional. This will save you the absolute most money of everything else I'm going to share with you. Get a good person to help you with your taxes. Now, it's not just at the end of the year, or I should say at the beginning of the year, right? When you're setting up your actual tax preparation for your returns. I'm talking about throughout the year. I mean, this is saving on taxes is a year-round game. It's not something you do once a year. So the key is to get a qualified tax professional to help you. What does a qualified person look like? Someone that understands real estate investing. Ideally, they own their own rental properties. Ideally, they've bought, renovated, and resold properties, so they both flipped or done short-term as well as long-term rentals. But even if they haven't, at least they need to know exactly what's going on in your specific region of the country. I think you should have it within your state. So I think the person needs to be state specific. They don't need to be in your town, but they need to be in your state. So they understand the different tax laws related to your state. As well, of course, they're going to understand the federal stuff. Okay, so where do you find these people? Get on it. Look for them. You know, I mean, it's a skill that you have to acquire if you're going to be successful in life, is the ability to find good people to help you. So a good tax professional that helps creative real estate investors, maybe you talk to other creative investors, maybe you talk to title company, real estate attorneys, talk to the different people in your area that are already doing this and who they're using. They may not be using someone good, so you may have to go through quite a few, but you got to keep digging until you find a winner. And then once you find a winner, that's the big one. Okay, so that's tip number one. By the way, they're gonna cost some money. They're not gonna be free, but that's okay. They save you money. So yes, you have to pay them, but in the long run, they save you money, so long as you're actually doing deals and making money. Okay. Number two, and the first thing that a qualified tax professional is going to tell you to do is get organized. Get organized. I hear the lament from people sometimes. Well, I'm not an organized person, and that's the part I don't really like. I'm more of a people person. You got to get organized. This is money we're talking about here. And so if you're going to save money, you got to be organized. That means that all expenses have got to go through a business bank account or a business credit card. Which, by the way, a business credit card is pretty sweet because it doesn't show up on your personal credit report when you pull it. Now, if you don't pay it, it might show up as delinquent, but it's nice. Business credit cards can be pretty sweet. So get all expenses on a business bank account or business credit card. Don't run any of your expenses through your personal bank accounts at all. Have it on a separate entity, separate stuff. All transactions need to be organized. Now, I'm a big fan of QuickBooks. You don't have to use QuickBooks. There's other services out there, and I guess there's new stuff all the time. There's a system called FreshBooks now, and there's some online things that can help you as well. Get it all in a digital format. That way, your professional can take a look at every single transaction and can help you determine where to reclassify things, what needs to be done in order to maximize your tax savings. You got to get it digitized. No, I mean, yes, it's nice to have the records of the receipts and all that in a folder. That's fantastic, but you got to get it all digitized. What I love about QuickBooks is that it can suck all the transactions out of the credit card statement or the bank statement and make things so much easier. I mean, literally, it should be real simple stuff. My personal bookkeeping on my personal investing of my own deals, is so simple. So simple. I mean, I literally just pull it down like once a month, once every 2 months, match up the transactions in about 15 minutes and I'm done. I mean, it's that simple. So don't make it complicated. But you gotta get organized. All right, I've drilled that one home. Okay, the next piece of advice that any qualified tax professional is going to tell you is you've got to separate income activities. Separate income activities. There's basically two activities you're doing in real estate, and as it relates to taxes anyway. And you really have short term and you have long term. Okay. Short term is anything a year or less, okay? This is your flipping, your wholesaling, your commissions, anytime you're making money on a deal and you aren't going to own it for any more than a year, that is short term. That needs to be in one entity, or more than one, but it's usually good just to be in one. Now, any rental properties you own, that's long term, that's passive income, that needs to be in a separate entity altogether. Does that make sense? So, by the way, I have a great video on what's the best what's the best entity for real estate investors. You can check out that video as well because it'll break down more about different entities. But the idea here is that short-term transactions go in one box and then long-term goes in another. Now, some people get into these debates about how many rental properties should you have per LLC. All right, that's in a different video. You can check all that out. The best entity for real estate investors. I just want to talk about the concept from a tax perspective. You got to separate these things, because if you don't, rental income can be considered short-term income, and this is typically taxed at a ordinary income rate. Now, in some cases, you can get away with short-term capital gains, but I'm pretty sure, and a tax professional can double-check with me on this, short-term capital gains and ordinary income are the same rates. So. Long-term capital gains is more than a year, okay? All right, great. So, you separate these two things. Now, if you've done that, you've really made some huge strides here. So all your investing, flips and wholesales, all that stuff short-term, all your rental properties long-term. Big, big difference. Next thing is you need to own rental property. I gotta tell you, rental property is some of the best income from a tax perspective you'll ever earn. It's fantastic. Now, here's why it's so powerful. Okay, so rental property, the money comes in from the tenant, right? And then you have to pay the mortgage if you've got one. You've got the taxes, the insurance. You're going to have maintenance on the property usually. You may have to pay an HOA fee. You may even have to pay a property manager. I'm not a huge fan of those, but there's expenses associated with owning rental property. And at the end, you get this thing called cash flow, right? And so let's say it's a single family home and you paid $100,000 for it and you're getting $1,000 a month, and after all expenses you've got a cash flow of $200. Okay, that's my little example here. Now, that's income, right? So after all the expenses you bring in $200 a month. So that's something that goes into your bank account. You can spend it, you can do anything with it. It's real money, correct? Yes. Now, watch this. There's this thing called depreciation. It is one of the coolest things ever. Depreciation. Basically, the IRS says that your house, your building, your structure, not the land, but the structure is going to deteriorate over 27 and a half years. So what they do is they take your basis in the building, the structure, which if it's a $100,000 house, your basis is probably going to be about $90,000 because the other $10,000 goes to the lot. So $90,000 divided by 27 and a half years, and I don't even have a calculator out here, round numbers, we're talking about $3,000 a year in depreciation. What is depreciation? It's an expense you get to put on your tax return, but you didn't actually pay it. I mean, you didn't actually come out of pocket for it. So depreciation in my little example is, at $3,000 a year, you divide that by 12, you're like at let's just say $275 a month. So you get to show an expense of $275 a month, but you put this in your bank account each month. So that means that technically you lost money from a tax perspective on a property you're making money on. That's what's so sweet about rental property. That's the big, exciting piece of it. Now, obviously, there's problems with rental property. You have to be a good manager. Landlording can be a hassle if you don't set it up right and you have the wrong tenants and your deal doesn't cash flow very strong and all those other factors. But on a tax perspective level, rental property is where it's at, because the depreciation can show a loss when you don't even have a loss. Oh, by the way, if you are not a full-time real estate investor and you can't prove that that's what your full-time gig is, there are some rules related to how much you can actually show as a loss against your regular income. And a tax professional would show you all about that stuff. There are some ways that you can prove that you have enough either hours or enough participation in your real estate investing to show that you're a real estate professional for tax purposes. And then no matter what the rental loss is, and your rental loss could be $100,000 a year, even if you're bringing in money, but from depreciation showing $100,000 a year loss, that could all go against your wages or your 1099, your W-2 stuff. Now, if I went too far down one road right there, sorry, just point this in your head, and that is real estate professional. That's a great way to be able to deduct losses on rental property that some people can't do. And that's definitely a power play of getting to a point where you're full-time in this thing. Okay, so these tips alone are just huge, powerful. The last one is really not just one tip, but a lot of tips all at the same time, and that is, earn like the wealthy. Earn like, I'm just going to say the rich. Okay, so you've probably heard these stories about very wealthy people who pay less in taxes than their secretary. Warren Buffett gave that example. Mitt Romney, the person that was trying to become president, they had showed that he had made something like $16 million the year before and only paid $1 million in taxes. How is that possible? How are these wealthy people paying so little in taxes? Well, it's not just because they're so genius and they know all the rules. It has to do with how they earn their income. That's the big difference. Mitt Romney was getting a lot of dividends from a lot of his investments. And so those are taxed a lot less than ordinary income. Rental properties are a perfect example. Passive income, long-term rental property with the depreciation, the tax on that is really, really minimal in comparison to what your ordinary income could be. So that means owning rental property, but it also means doing cool things like not spending all your money when you flip deals sometimes, but instead doing a 1031 exchange. 1031 exchange, what's that? What that is if you sell your property, whatever the profits are, let's say the profits were like $100,000, you would have to take all of that money and you would put it into a new property. And so if you took all the money from the sale, all the money, and you put it into a new property, then you wouldn't have to pay taxes on that sale. Now, it's not that the taxes go away forever. It's more like tax deferred. But watch this. So if you do a 1031 exchange, so we'll go back to our $100,000 house example right here. Let's say you sold it for $200,000. So you make $100,000 in profit. And you use all $100,000 sheer profit and you buy another home at $100,000, free and clear. Well, you just deferred your taxes from the sale on this one, and now all that rental income that comes in, that's income to you. And now you still have to pay the normal tax associated with long-term passive income with the depreciation, but you didn't have to pay taxes on that sale. Look, I mean, if you're in a higher tax bracket, on $100,000, that could be, 30, 35 grand. That's a lot of change. So to be able to keep that and put that back into real estate is wonderful. And then what some people do with these 1031s is they will do a refinance to get their money out a little bit. And so I'm not that situation is going to be best applicable on a deal by deal basis. So you don't always want to borrow out of this stuff if you don't have to. But the power here is that if you earn like the rich, you can earn money in such a fashion where it's extremely tax advantaged. It's not easy it takes time to build up these assets. It takes time to put your structure in such a way where you're earning money that way. So there's a good saying that says, if you want to live like nobody else, you got to live like nobody else. So it doesn't mean that you need to live the high life on the way up, but if you can be patient and you can move your assets into the right structuring over time, sooner, actually I should say later rather than sooner, you'll get to a point where you're earning great income and it's incredibly tax advantaged. All right, well, I'm Phil Pustiowski with FreedomMentor.com. I hope you enjoyed these 5 tax-saving tips for real estate investors. The number one, of course, is get the qualified tax professional on your team. Figure it out. Find that person. They will help you tremendously. But also get very organized. Get all of your transactions digitized. Separate your income activities. You may only need 2 entities. I've got a great other video on that called The Best Entity for Real Estate Investors. Check that out. Definitely own rental property. Now, you have to be selective on the ones you own, because just because it's tax advantage doesn't mean it's always a good deal. But get to a point where you own really well cash flowing, well performing rental property. It's awesome tax advantage income. And then take it to the next level, earn like the rich, get into things like 1031 exchanges, things where you can take it to an entirely new level. All right. Thank you so much for watching this video. If you love this, please comment, please give it a like or whatever. If you've got questions, of course, you can comment down below. I try to carve out time out of my schedule to respond to those. I've got a best-selling book, How to Be a Real Estate Investor. You may want to check that out as well. All right, thanks so much for watching, and I'll see you on the next video.